This is Michael Loftus with Wealth and Wisdom TV with another fast financial tip. We're going to talk about the recent Fed cut and the impact. So let's start right here. Our cycles, we've been talking about it. Where are we right now? Growth slowing. Hello. S&P earnings growth 0.68% through last night. Inflation decelerates. Saw that. We peaked in inflation in January. Fed is dovish. Well, they proved that today. They were behind the curve. We're going to talk about that. And markets start to deflate. So why did they cut? Obviously, the coronavirus, I think it was a little bit too early. We'll talk about that in a second. But here, they were behind the curve. You've heard that before. You've got 10-year Treasury at 1.1, and their rate was much higher. So they needed to get in line with the 10-year, because the 10-year was screaming something completely different. Okay? And then you look at what's the impact. We don't know yet, but I do know from the past, 2000, 2007 through 8, when they cut as things get rough, it doesn't do any good. All right? I think they cut too early. It's not going to leave them a lot of ammunition. Why? Look at the slide right here. You have your S&P. You have your Fed fund rate at 1.55. You've got unemployment at 3.6 and your 10-year at 1.10. And then you go back. Green are previous recessions. 6% and 5.25 Fed fund rate, respectively. That is ammunition. They just took away 50 basis points, and there are no signs of a recession today. That is a problem. Okay, so what do they do from here? Well, the next step is they're going to get real close to zero, which seems real silly to me. So what's next? Stick to the process, right? We've been talking about our cycles, making sure that we've been in bond proxies, which are holding up well today, and gold, which is soaring today. Not surprising with this cut. So stick to the process. Don't have a process? Give us a call. We'll explain ours. Thanks so much for watching. Michael Loftus, Wealth and Wisdom TV.